Okay, let's just moved over onto the. Just click that. Go away. What's it? Let's move that out of the way. Just are there any questions? Great, thank you all, one and all. Brilliant. Okay, let's move that out of the way. Okay, on to gold. We've had a really nice move on gold, but what I actually wanted to show you here was really just the power of the volatility indicator. It's such a simple indicator, but it is so powerful. And we've got two examples here, but let me start with the 30-minute. There we go. I've said this many times, but if I'm in a position, and I said it earlier on, if I'm in a position and I'm positive and I've got some profit in that position, and I get the volatility trigger like this, irrespective of what time frame, then I will almost certainly close out most of that position. Not always all of it, but certainly some of it, and take it off the table, bank that profit, because I don't want to sit through what it's like to follow. The indicator works on average true range. It triggers in real time. In other words, as soon as this price action moves outside the average true range, I don't know where it would have been triggered in this case, but probably somewhere around here. So as soon as you get that trigger, it instantly tells you that there is volatility. From volatility, we can assume that there is participation from the insiders, the market makers, or the big operators, and yet that's reflected in terms of volume. So they are in here. They've forced this market up. Traders will then have jumped in on the fear of missing out, which is what volatility is all about. It is the fear of missing out. It's a natural reaction. We are designed to work that way. It's built into our DNA. We can't help it. It's just something we all have to live with. When we see something like this happening in terms of trading, then our instinct is to jump in to make some quick profit, make some easy money, and that's what volatility is there for. That's why it occurs, and it's almost always driven by the insiders and market makers racking profit up the price action up very fast to draw you into the trade on the fear of missing out on some quick money. And generally what will happen is that the market will either congest or reverse. In this case, it's congesting. We're congesting in the spread of the candle. You as a trader don't want to sit through this. This is painful. Remember, this is 30 minutes. So we've got, 6 or 7 candles here. So this is several hours of pain. Longer term, we are bullish gold, but in terms of sitting on this as an intraday trader, it's pretty painful stuff. So it works on two levels. It's frightening you in terms of indecision, and secondly, it may also take you out in terms of a stop. If you've got a tight stop at the top here and you've jumped in late, you're Johnny come lately, you're probably going to get taken out anyway. So it really makes no difference one way or the other. Ultimately, if the market carries on, that's fine. But as a trader, if I see this signal coming in on the market, I'm out. Take most of my position off the table and I get out of the market. I might leave 1 or 2 to run, whatever it is, however many I'm trading. If you're in a loss position, it's a much harder decision to make. You may get lucky and you may get a reversal. If you're in a losing situation, the situation may get worse for you. You have to make a decision. It's a tough call. There's no easy answer to that one. It's an easy decision if you're in profit. It's a much tougher decision if you're in loss and that occurs. So just be aware of it. It's a very, very powerful indicator. Once the market, if you're long and you come out or you close most of the position out, close all of it out, and you're looking to continue the trade, well, if the market carries on, so what? You've lost nothing. You jump back in again. Once it's cleared the top of that candle, you're good to go again. I mean, this is an example where it did follow through, didn't trade within, it carried on up. We've got a ton of volume underneath. It even went a little bit higher. So once that's cleared there, you could jump back in again. Okay, you've got another volatility, you might close out again. Now we're topping out. Now we're moving into the congestion phase of the second candle. So it's not, there's nothing in trading which will guarantee you, but it gives you that warning sign that yes, we've got volatility, yes, we've got participation, big participation by the market operators, the big operators, or the market makers, whatever situation you're in. If you're in Forex, doesn't matter. In futures, it's exactly the same. Indices, commodities, makes no difference. It is so powerful. And as I say, whatever market you're trading, you've got it, here it is. You know, we've got another one here. This came up on 10, it followed through. That was the trigger. We'd have seen it down on 15 coming in. It would have alerted you. Maybe you removed all of your position. Okay, once we're clear, we're good to go again. We can jump back in again. That's the way to trade it. Now, as we get to the top here, you can see we've got these three, lots of volume here. Then we get a ton of volume here. We're starting to see this weakness. It's confirmed on the next candle. We've got big wick to the upside, got lots of volume coming in, and now we're trading in congestion. Why are we trading in congestion? Because we've got the volume point of control in play. So we're trading around that. If you're a breakaway trader, it's patience. Wait for the market to break away. If we're looking to the upside on this trade, through 44 and up to 46, you know, volume's falling away on the 10-minute. It would move without a great deal of effort through that region and on up to the next level. And the trend monitor, you can see here, is supported throughout that move. And it's still flashing blue, still confirming that we're in bullish momentum. Just got to wait and be patient. I'm going to pass back to Anna at that point, if I may. See what's going on one or two others. See what's going on in terms of oil. Got a nice move in oil here going on. Again, you can see the volatility has come in, triggered, starting to move into congestion. Just be aware of it. That was the volatility trigger to the downside. That was the collapse in the oil price. We traded within the range of it, which is what we expect to see. Now we're starting to see the reversal take shape. The next stage for oil is to break up to the volume point of control, which is sitting here up to $28, $29 a barrel. Once it gets to that, we're expecting congestion. It's bullish at the moment. We've been writing about oil. We've also written about gold extensively over the last few weeks. It's now coming up to this technical level. And obviously, a lot of the oil price is driven by what is going on in terms of politics, OPEC, and supply and demand. But from a technical perspective, that's where we're expecting congestion to follow sub $30 a barrel.